Hello, everyone. Welcome to the Multifamily Freedom Chasers Financing Zoom. My name is Shelly Miles, and I am the co-founder of Adventure Commercial Capital. Thank you guys for turning on your camera. Together with Jerry Miles, I'm the co-founder of Adventure Commercial Capital, which I will bring him up to you soon, so he can explain everything else. Okay. Thank you all for being here. So I just wanted to remind you guys that this platform that we are in right now is not just for educating you guys, it's also a place where you guys can connect and get to know each other. Okay, because this is how we can get deals done, right? So don't be shy, go ahead, and why don't everybody drop their IG handle in the chat? And I have my little helper here today. Look at him, he's so cute. Drop your Instagram handle in the chat. JJ is going to share ours every now and then. Jerry posts some videos on commercial real estate that you guys might find interesting. So go ahead and connect with each other like that. And usually when you guys add me as a friend, I usually go right back and follow you guys back. So how many of you, let me know in the chat, how many of you think these financing Zoom calls are important to you as investors? Let me know. All right, if you guys do, I want you guys to do me a favor in about 10 seconds. I want you guys to pull your cameras out or take a screenshot. And I want you guys to take a picture and post it and remind everybody that there's still time to join, okay? So I'm going to smile and you guys can take a picture and I want you to post it. Post it on Freedom Chasers, post it wherever, all right? You guys ready? All right, go ahead and post that, guys. Thank you. Okay, and one more thing. After the Q&A, we are going to share something with you guys. We have a fun event that you guys can take advantage of, and we want everybody else to get in here so they can also take advantage of this fun event, and you guys can take advantage of it if you like. So don't leave after the Q&A. I'm only going to be sharing this on here on our Zoom calls. I don't know, we may share it one more time, but don't leave after the Q&A. Let's see. Okay, good. Okay, are you guys ready for the main topic tonight? Let's put some fires in the chat and I'm gonna bring Jerry on right now. So go ahead and put some fires in the chat for him. And here is Mr. Jerry Miles. You can take over now, dear.
All right, great. You want to share your screen with the
I will
slides?
share my screen.
All right. If you are new here tonight, I'd like to welcome you and all of the regulars. I see a lot of familiar people as well, but I see a couple names that I don't recognize and don't know who you are. But if you're new here tonight, throw a 1 in the chat. Let us know. We'd like to welcome you. All right, Lance. Good to see you here, Lance. And all right, I can't keep up with everybody. But yeah, welcome to all the new people and everyone else that has been here before. Welcome as well. And
No.
I'm Jerry Miles. You just heard from my wife, Shelly. And we also have, well, I think all 3 of my sons are on here today. So there's Jordan with Shelly there, and then JJ and Riley on here is my son as well.
Yeah, I think Riley should turn on his webcam there so we can see him.
But, Today's agenda, we'll talk about our ecosystem with the multifamily freedom chasers. We'll have an introduction to ourselves. We'll give you guys a chance to introduce yourself. We'll talk about the current debt market. And then our main topic tonight is what you need to get your deal funded. And then we'll have some Q&A. So it's should be a good time. So first, if you guys are not a part of the Multifamily Freedom Chasers Facebook group, Shelly or JJ1 will put that in the chat, a link to that, and you can join the group. But this right here, guys, the information and things that the Freedom Chaser community is offering, most other places, it costs a lot of money to get this kind of education and to be a part of this kind of community. And everything here with the Multifamily Freedom Chasers is totally free. Doesn't cost a thing, but your time and your energy to be here and willing to learn. So Sundays, we have what they call the activation Zoom with Marcel and Trevor and Victor. We have broker calls on Mondays during the day when brokers are answering their phones. Peter St. Martin and Eddie Charger are hosting that one. And they just, it's what it says it is they just sit and they may actively make calls to brokers. And so if you're maybe a little shy and afraid to call a broker, that might be the call for you to get on and be able to come out of your shell a little bit with some backup there with these guys who are talkers and can handle themselves on the phone. So Tuesdays we have napkin underwriting with Eddie Charger and Edward.
Introduction.
So we're still at that phase, huh? Spend a waste of time
And
to the goal.
Yep. You want to bring your chair over?
I just want to get rid of my computer.
then on Wednesdays you have us every other Wednesday, and then the Wednesdays that we don't have a call, Victor does what is called advanced underwriting,
in the chat, dude.
and he
What's it look like in the chat?
and he goes deep dive into markets and all kinds of different things. So if you haven't plugged into the community, I encourage you to do so. And it truly is a good place. I know there's people on the call here that have done business together and grown their network and their business through these Zooms and through this community. So encourage you to join the group. So go ahead and slide it on up. So, like I said before, I'm Jerry Miles, and that's my wife, Shelly, and JJ and Jordan there in the background. And if you guys see Riley in the Zoom here, say hello to him too. He's the oldest. But we are commercial mortgage brokers and the founders of Adventure Commercial Capital. We started this business 3 years ago, right? Just a couple months before COVID hit. So now we are in our second storm since starting this business with the way the interest rates and things are going. But we started this business because we saw a need for lending brokers who had some integrity and we're going to be honest with people, not overcharge. As we were young investors, we had some different brokers that we felt were taking advantage of us. And because of that, we decided to join the National Association of Commercial Loan Brokers. Went through their training to start our business. Got a lot of contacts through them for lenders and have been growing our lender base since then. We focus primarily on investment in commercial real estate, apartments, fix and flips. If it's investment real estate, we can find a home for it and finance it. So. And if y'all would like, take a screenshot of this page or take a picture with your phone. This is mine and Shelly's email, and that is my cell phone. You know, we're open and ready to take calls and answer questions anytime anybody has anything. So, and we'll put this up again here before the end of the call. So if somebody missed it. So this time I'd like to, we've told you about us. And we'll, 3 or 4 people we got time for can each raise your digital hand. We'll unmute you and tell us a little bit about yourself, where you're from. Tell us about anything. But we do ask you to keep it to about a minute or less. We don't want to keep everybody on here all night. So, all right, Robert, I knew I could count on you.
Yes, sir. I'm here as often as I can.
Yeah.
My name is Robert Dodd. I'm up in Minneapolis, Minnesota. I'm going direct to broker for a team of owners. They're based out of Texas. I'm very fortunate to be working with both Max and Steven that are in the call tonight. And I just want to say thank you again for the Miles family, not only for doing these every 2 weeks, but my first quote for commercial property came from your family. And we're only going to be sending out more LOIs. So you'll be hearing from me again really soon. And I started off knowing next to nothing, 6 months ago. I'm just an average person. Anyone can do this if you just do a little action every day and keep networking. So anyone who's brand new, I'm going to put my information in the side chat there. But I do endorse the multifamily freedom chaser ecosystem fully. So thank you again.
Yep. Thanks, Robert.
Awesome. Thanks, Robert. That's great. 6 months ago, I didn't even know that. Wow, good for you. And you just put in a $19 million LOI. Wow. That's
Awesome.
I networked and found a team that picked me up, and that's the only reason. And I learned a lot here and from the Freedom Chasers. So yeah.
Networking is great, guys. Come on, share your information, connect with each other, guys. Come on, let's go.
Yeah. All right, Lance.
Hey guys, I'm Lance Riggin. I've been an entrepreneur for about 20 years now. I sold a brick and mortar that I'd built from the ground up and started flipping houses about 6 years ago and decided that I wanted to move into real estate investing full time last year. And so my wife and I are a team, visionary integrator team. We're both sub-2 students and also Gators. And we're really just starting to rebuild our brand, and buying multifamily is part of the journey, and midterm rentals. So glad to be here.
Good to have you here, Lance. All right, anybody else? JJ, you want to tell us about what you're doing?
Yeah, I just joined a really big YouTubers mentorship program, and there's a bunch of really big YouTubers in there, and I'm networking with a bunch of those people and learning from them, and get to do calls like every day, learning about that, and it's pretty cool.
Awesome. And JJ's also now working for, he's done some video work for a few real estate investors here in the groups, and now he's got one that is one of the bigger guys in Grant Cardone's club that he's now helping manage his YouTube channel. So he's been growing his business through all this as well. So his YouTube business. So it don't matter how old you are, if you've got breath in your lungs, or how young you are, if you've got breath in your lungs, you can do something productive. So
Also, one more thing. Sunday is JJ's birthday. He will be 17 years old. I can't believe I have a 17-year-old, but yeah. I don't look like it though, right? All right.
Well, speak up. Speak up.
Edward.
Yeah, hi everybody. My name is Edward Tende. I've been located in Cincinnati, Ohio, and then I'm pretty much a general contractor. And what we do home renovation, improvement, and restoration. So We can move, we can go anywhere. If you have a project, you can contact us. We should be able to knock that down for you. Doesn't matter how big the project is, but give us a shot. We should be there for you to support everybody in this community. Thank you.
Awesome, Edward. Awesome. Okay, well, let's get started. We'll talk about the current debt market here for a few minutes. I mean, everybody knows, you know, I'm guessing everybody knows what the Fed did yesterday, with bumping us up another 50 basis points or 0.5%. You know, I like how they always speak in a different language to kind of confuse everybody and to keep everybody, you know, not able to understand what they're talking about and not wanting to keep an eye on them. But, you know, 50 basis points is just 0.5%. So, you know, anybody that didn't know that, but, you know, they're going to continue raising rates. I feel like, in my estimation, they're going to continue raising rates. You know, the people are still spending money. People are, you know, if you've been to the grocery store lately, I know some of our favorite foods at our household have gone up a whole bunch here just like in the last month or two. You know, so if you've gone out to eat lately, you're feeling it. You know, pretty much anywhere you go to spend money, you're feeling the inflation. And so as long as that's happening, we're going to keep seeing rates increase. You know, I'm in Grant Cardone's real estate club, and I mean, he was on today. He was fired up, and he's not a fan of Jerome Powell at all, and was saying he's trying to crash the market intentionally to hurt the middle class and things, you know, and could be true. You know, I don't know, but it's definitely going to hurt the middle class. That's for sure. As this happens, you know, if you could have afforded $1 million house, you know, 8 months ago, you know, you're probably only going to be able to afford a $450,000 house now. So, and so that's hurting. That's hurting. That's hurting people that are needing to sell. If you're needing to relocate, if you're an apartment owner and you have rates coming due, and getting ready to adjust, you're going to be in bad shape. There's a guy in the club that's got 24 different complexes that he owns. And this isn't Grant, but it's a different guy in the club. And he said he's got 10 of them right now that are in danger of the rates changing on him here over the next few months out of the 24. And so he's working on restructuring all of his debt, and obviously restructuring higher rates, and his cash flow's gone. And he's just hoping right now that he's going to be able to do it without losing any properties. So there's a lot of people in that situation. I know that Grant shared, there was a news article where $500 billion from one lender is coming due this year. And next year they have $350 billion in real estate debt that's coming due. So when I say that's coming due, that means their 2, 3, 4% rates that they have are now going to be changing to a 6 or 6.5% rate, where the current rates are. And so, you know, maybe their monthly payments are $150 now. Their monthly payments are going to go to $250 or $350. You know, who knows? And they're not going to cash flow, and they're going to slowly bleed out. And that's where you hear people saying, "Hey, you know, there's going to be blood in the streets," and this is what they're talking about. All these owners of property that, you know, have debt coming due. You know, maybe some of them overpaid. Maybe some of that stuff happened. But you know, whatever the situation, they're going to be hurting, and they're going to be ready to make deals. So be ready to buy. Grant just keeps saying in the real estate club, buy, when there's blood in the streets, even if it's your own blood. So, just kind of that's what's going on. Go back to that page one more time there that you're at. So the current rates, the Fed rate, they bumped it up yesterday. I think when it settles in, we're going to be over a five mark here with the Fed rate here over the next week or so. The SOFR, the secured overnight financing rate that the banks trade at, last night was at 4.55. When you guys get quotes sometimes from bridge lenders or from us, sometimes you'll see when I get rates from my lenders where I'm turning them over to you, the customer, they'll say, well, we want to be 3 points over SOFR, or we want to be 2 over the Fed, or 2 year over the 10, or 2 over the 10-year treasury. So 2 over the 10-year treasury would put you at 5.97. So just, and just kind of a side note, I think I mentioned this last Zoom as well. If you're looking at agency debt for an apartment building, right now, the 10-year treasury 3.97. If you add 1.5 to 2.5 over the 10-year treasury, that's kind of the ballpark of where your rates would be when you're looking at Freddie and Fannie debt. So what are my lenders saying and doing? The lenders are getting frustrated as well, as I know a lot of you guys are getting frustrated, been putting LOIs in, been trying to buy things, and it's getting harder and harder to buy as rates are going up and owners aren't wanting to give up the properties at a discount, which they have to do now to get it sold. The lenders are kind of in the same boat. They want to lend money. They don't make money unless they're lending money. Some of them are scared. We've had a few different lenders here recently, private lenders, that have backed out of the market altogether. I will tell you that even Freddie and Fannie came out this year really strong, saying, hey, naming off all the things that they're going to do this year. We're going to do this. They're walking all those things back now because they're seeing that they're not going to happen the way that they want them to happen. So, for us personally as brokers, we know there's a lot of brokers that are pulling back, advertising dollars and all these things. Well, we're committing even more money to those things. We're committing more money, and where people are letting off, we're going to take market share. So, and hopefully we can do that with you guys as you guys are trying to get some deals. Hopefully we can fund them, and we can all grow together. So, going to the next slide. One thing that Freddie and Fannie has not backed down on is that they are wanting to lend on 5 to 50 units this year. I mean, they've got goals, $2.5 billion each. Freddie and Fannie each want to lend that much money on and up to 18,000 units in this space of 5 to 50 unit properties. They saw that this was kind of an under acknowledged space, I guess, before, but they're really looking to lend on these assets, and really, Freddie and Fannie, they have a small balance program. Fannie goes 2 million to 6 million. Freddie goes 1.5 to 7, or 1.5 to 7.5, and then they have their conventional program, which takes up at the 7 million or 7.5 million, and then takes off at the 6 million. All through, for the longest time, the conventional programs had lower rates, a 0.5 point, 0.75 point lower, sometimes a full percentage lower than the small balance rates. Well, right now, the way that they have, that they're doing things is they're pushing these smaller units. The small balance rates are really close to the conventional rates right now. So if you're looking to buy smaller properties, the 5 to 50 units range, this might be a good time to do it. So go ahead and move on to the next one. I think the next one here is our main topic, which is how to get your deal funded. And we're talking multifamilies here. First thing, we're going to talk about qualifying the property. So we need to qualify the property, and then we need to qualify the borrower. So those are the two things that we need to worry about. The first thing, qualifying the property. All lenders, including Fannie and Freddie, like to lend in areas where there isn't really high crime rates. And I don't know, I mean, the lenders themselves, I don't think they care that it's a high crime rate area, but throughout history of banking, high crime areas have a lot higher default rate than areas that are not high crime. People buy properties a lot of times that, you see, and we've done it too. When my wife and I started investing, we invested in properties that were cheap and we could pay cash for, and they weren't always the nicest locations. They weren't always, and yes, we would carry guns to go collect rent and those types of things. And because of that, I mean, a lot of landlords would, get, discouraged and give up on the properties and just give up, and they would default on their loans. And so lenders really like to see areas that you can go and collect your rent, and not fear for your life, I guess, or not worry about your car being stolen while you go in the building or whatever. So that's the first thing. Next thing, DSCR, when you're looking, 1.2 or better. And DSCR just means that the property's annual income exceeds the debt service by 20%. So a lot of people call, and when they call and ask us about things, they're wanting interest only and those types of things. You're not going to get very much interest only, maybe a year or something with that 1.2. We deal with several different, as brokers, we do a lot of the agency financing, but we have three different groups that we go to for our agency debt. So when you come to us, we're shopping you to three different shops that offer agency debt. And one of them, to get any type of IO or interest only payments, you need like a 1.4. The other two are 1.25 to 1.3. We can start doing, multiple years of interest only. Then the property will need to pass, all the third-party reports, the appraisals, physical needs assessment, engineering, the environmentals, the legal paperwork, all that kind of stuff. As something else, when we're looking at agency financing, and that's what we push mainly, because agency financing, Freddie and Fannie are mission based. So they're here to provide the best rates. They're here to make housing affordable for all, enacted by Congress just for that purpose. So they don't have to worry about the same profits as a small bank. They don't have to worry about the same profits and covering their expenses like a private lender has to, or an insurance company that lends on these types of properties. So they do offer the best rates, the best terms. There's a few things when you're looking at properties that will hurt and just kill the deal right off the bat. And one thing I'll say, I didn't put this on the slide, but one thing is locations that have a single employer. So if you're next to a military base, they do not like to see more than 40% of the people that are renting, of the tenant base. They don't want to see more than 40% being military personnel. And it just saves them from You know, what if the base they decide to move the base, or, you know, a big portion of the base goes somewhere else or something, that'll really kill the tenant base. So they like to see that there's less than 40% of the property is military. You know, we can still go back to the other page still. We can still lend on those deals, which just can't be done through agency debt. And you're going to be, you know, a point to 2 points higher in interest rate. You know, the terms aren't going to be as favorable. And also Airbnb, they don't like to see more than 10% of a property being Airbnb or short-term rentals. And then if it's a college area, they will lend on student housing. Fannie will lend on student housing. Yeah, Fannie will lend on student housing, but it has to be a one of the big universities. Like here where we're at, we have Northern Kentucky University, and we have not too far from us is UK. Northern Kentucky would be considered a secondary college. UK is the big state school. University of Kentucky, they would lend on one more likely at UK because that's going to be more stable. The NKU, they might not. You know, and right across the river from us, we have University of Cincinnati. They would definitely lend in that area. Fannie would. So you can go ahead and go on to the next one. So qualifying the borrower. And now I want to tell everybody, it's really common when you're getting into the multifamily space. You're going to need somebody that has some experience. You know, if you start with a 5 and then move up to a 16 and a 30, and, you know, you move up that way. Yeah, you mean you can do it yourself. But if you're moving straight from single families and you're planning to buy a 50 plus units, you're going to need a borrower, a partner with you that has experience with bigger properties. You know, or you're not going to be able to qualify. So the borrower needs experience, net worth requirements, and this is just a general rule on any commercial real estate. Besides, you know, if you're buying commercial real estate with like an SBA loan or something, but your net worth requirements, you need to be equal or greater to the loan, or your net worth needs to be equal to or greater than the loan amount of the property, or the funding of the loan amount. So $10 million loan, you're going to need to have a net worth of 10 million or better. Now, if you have 2 partners and you 3 together combined have a net worth of 10 million, we can make that work. You know, so there's people in this room here that I know can buy a $10 million we So, you know, I know them, I've met them, we're doing deals together. So when we talked about the beginning of this call, that, hey, make sure you're networking with people in the groups. There's people in these groups that have the ability to buy these properties and have bought these properties. So credit score 660 or better, especially when you're applying for agency debt. They will, you know, you're not basing it on your personal credit, but they do look at your personal credit. And it's more of, you know, I mean, I've heard some people say, you know, your credit check or your character check, but it's more or less just making sure that you haven't gone to defraud anybody, you know, making sure that you're not like, you're not in a bankruptcy, that kind of thing. But 660 or better is what they look at. If you listen to a lot of the gurus out there, they're going to say, oh, I buy these big properties with no credit, with no money and all this kind of stuff. Well, they have a partner with the credit and they have a partner with the money. So, or they have a partner with the experience. So just know that's how it works. You know, Grant says it all the time, and you know, it's not misleading people, but I mean, he's buying a lot bigger deals than we're looking at now. I mean, he's buying, you know, the 9-figure deals now, and you know, and doing business with people he's done business with in the past. So he probably doesn't have to show his credit score because they already know him. But if you're going for an agency debt, you know, you're looking for a $20 million loan, they are going to look at your credit score. And I will say, you know, that on the agency side, none of these requirements are written in stone. So when we're talking minimum loan amount on the agency side of 1.5, the agencies will fund deals down to $1 million. They don't advertise that, but they will. So just the FYI, the credit score can even be kind of, you know, they aren't going to hold you to that if you have a lot of cash or you have a higher net worth or you have a lot of experience. And let's say you come in at a 640, they're going to overlook the credit score. You know, the agencies like to say that we're fluid, and just that they kind of roll with the punches. If one thing isn't where they need it to be, the next thing is, and they're going to go with it. So, you're going to got to have cash to close these deals. You know, in the past, it was customary, you know, that you'd get as much loan to value as you could. You know, Freddie will give you 80% loan to value. Fannie will give you 75%. You know, they still will, but everything we've seen lately has been constrained by the DSCR. So a lot of them are constrained down to 65% of the purchase price because the DSCRs just don't work with the higher interest rates. And then it causes people to need to raise a lot more money, and it kills deals. So we are, you know, kind of going back to the current debt market. We are still at the beginning. I believe we are still at the very beginning of the downturn of the real estate market. The real estate market just don't one day up and just turn over on its side. It's slow moving, especially in the commercial space. And I mean, we could be a couple years here with kind of the turnover of the market. So so don't feel like, don't get FOMO and feel like you're going to miss on something and you have to buy something today. I think that we're going to be seeing a lot more deals coming to the market here over the next 6 months or so. Grant and his team, we're talking the third and fourth quarter of this year is going to get really juicy with deals. So don't get FOMO. Just keep on what you want to buy and how you want to buy. But you got to have cash to close the deal or be on the way to raising it. So my lenders are going to come to me and say, hey, we're writing an LOI on this guy's deal. We need to see his bank statements that he's got the down payment money. And I'm going to say, well, he's raising the money, and I'm going to have to argue with my lender a little bit and tell him, look, you know, we're part of this club together. They're with me, you know, they're working to raise it. We're going to be able to close this deal, and I'm going to go to bat for you. But they're going to be pushing, and some of them will push hard, and I might have to go to another lender. I've had that a few times where I'm trying to go back to bat for people, and I'm just I'll move on to another lender that wants to be a little more friendly. But and so when you're after we get a deal and we're closing the deal, we have all the cash raised, we're at the closing table, we're still going to need on the borrower's end another 2 to 6 months of reserves after closing. So you're going to need 2 to 6 months of reserves. I like to say 6 months just so nobody's surprised when they come back with more than 2. But 6 months of reserves after closing. So 6 months of running costs for the property. So that's qualifying to borrow, qualifying to property. Hope that cleared some things up for people. But I guess we can go to question and answer if you'd like.
Hey, Jerry, Matt Strayer.
Hey, Matt,
Hey,
how's it going?
Good. How are you?
Good.
And on the 2 to 6 months of reserves, we're good to, can we raise that also?
Yeah.
Okay.
Yeah, that's what people do most of the time. They raise everything. I mean, you raise your closing costs, you raise, every part of your deal you raise generally. So
And I guess just out of curiosity, so with commercial mortgage-backed securities and agency debt and the different options, like why would anybody go with those options? Like what would make those more favorable rather than agency debt if most people are wanting that longer term with a lower rate?
well, the CMBS, the commercial mortgage-backed securities, I don't really go after those when it comes to apartment financing. And just the reason is, I mean, they kind of got the same stipulations, everything, but they've got some higher rates. The terms aren't as good with the CMBS. And with CMBS, we go to CMBS. We have some CMBS lenders that we go to when we're doing storage deals or when we're doing hotels. I've just not messed with them with apartments because they just don't have as good of terms and rates. So
Mhm. Okay.
Hi,
But,
question.
yeah, go ahead.
So the financing is only for stabilized properties, right? Not for properties that need work.
Yeah, well, what we've talked about today is properties that are stabilized. Yeah. Actually our next week's or not next week, but the week after. What is the date on that, babe?
Say that
The
again, I'm
date-
sorry.
The date for our next Zoom will be
It's on the
22nd.
22nd.
Yeah, the 22nd. Our next Zoom is going to be on bridge debt. We'll be talking all about bridge debt, construction money, and all those things. And so, I haven't talked a lot about bridge debt because in my eyes, I mean, there's a lot of people right now that are hurting because they took a bridge loan a year and a half ago and then they couldn't get out of it because of the raising rates. And so there's some people that are really getting stuck right now that were in bridge debt and they just don't have an exit strategy anymore because they spent more than they can get out of the property now and they can't borrow what they need to pay the bridge debt off. And so there's a lot of people really getting hurt, and the bridge lenders, they're getting hurt. I mean, they're upside down on some of these properties that they funded. And so right now, I mean, unless it is just surer than sure, I really, caution people on bridge debt. Just because, I mean, most people in this room are syndicating their deals or they're raising capital from friends and family and coworkers and all that when they buy deals. I would hate to see anybody buy a deal and get into a deal and then have to sell at a loss and lose all their friends' money, and with bridge debt being 1 or 2 years, I mean, if you get into a bridge loan today, you better be sure that you know what you're doing because there's just a lot of room for things to go south on you right now in the market that we're in. So,
Righto.
but we are
Yeah.
going to be talking about that in 2 weeks, and we'll be talking about construction and all those things, and mainly with bridge debt, the thing that you need to look at is that when you get done with the work you're doing, all the things that we talked about on the property, that property can qualify with all these things, because if you want to be able to refi out of the bridge debt or to sell, somebody else is going to have to finance the property, or you're going to have to refinance the property to get out of it. And so it's going to have to meet all the requirements that we talked about there on the first page. So
Okay.
hope that helps.
Yeah, absolutely.
So we have this up here, needed for a quote. The first 4 items we're gonna need for a quote, and then eventually we're gonna need the second 2 items if you guys want to take a screenshot of this. I'll leave it up here for a minute, but go ahead and raise your hand if you have any questions. I see that Aldo has a question, but I'm not gonna read yours, Aldo, because there's some new people on here. I want you to introduce yourself, so go ahead, let's go.
Hey, what's up, guys?
Hey, what's up, Aldo?
Just hanging out with my favorite debt people here.
Yeah.
Yeah, I'm Aldo and Chet. I'm with Stoic Holding Solutions, and we are looking for properties in the Birmingham, Chattanooga, Knoxville area. We've been saying 50 plus, man, but this 1 to 50 unit, basically low amount of unit program that they have is starting to sound a little more intriguing, especially with the current debt market. So we'd love to learn a little bit more about that and how much more advantageous it is than some of the regular low balance loans or anything above 50. But anyway, that's not my question. My question is about the reserves. Does that have to be an escrow, or do you just have to be able to show for it?
It'll need to be an escrow as you close, yeah.
It will need to be an escrow. so
It'll be an escrow as you close.
as you close.
Yeah, yep.
But after that, it doesn't need to remain an escrow.
It don't need to remain an escrow, no.
Okay, got it. And then I had a follow-up question on that. We talked about the requirements from the liquidity and the net worth, those requirements. And is there a requirement from the agencies, or maybe not a requirement, but do they like to see, say, for example, if you're bringing on a KP, do they like to see if you are, if they're going to be investing into the deal as well? Or, basically carrying some of that equity?
No, I mean, the KP, if they're signing on the debt, they have the net worth, they're signing their name on the debt. I mean, they're signing on and saying they're good for it. Then as long as the money's there, then you should be good.
You haven't heard agencies asking for the KPs to put in some cash into
Nope.
it? Got it. All right.
I've never heard it.
Sounds good.
Yep.
Thanks for the answer.
Yeah. What's up, Robert?
Yeah, the team, just like most teams, we're looking for properties that have some amount of assumable debt, at a lowest interest rate as possible. If we're looking to add new debt onto one of those properties, does having that assumable loan maybe get us a better rate? Is that a factor that lenders look at, or is it not really change the debt quote too much?
Oh, if you're looking at like a secondary loan?
Yeah, or is that even an option?
Yeah, that's an option. Generally, I have some lenders that'll do those, mezzanine debt or something similar. We haven't, it's not been a thing for real long, as far as how common it is right now, as people are assuming debt, it's getting more popular. So we haven't done any of those. But I do know that it's really doesn't happen on the smaller deals. My mezzanine lenders don't lend under 3 million at a time. And so when you're looking at, secondary or some equity portion of the deal like that, it's going to be a bigger deal when you're doing that. So, I mean, if you submitted a loan, not LOI on what, 19 million today, is that what it was?
Yeah, 19. Oh boy.
Yeah, so I mean, there's enough room in there for some, if you're assuming a debt at like 45 or 50%, there's probably room for another 10 or 15 or 20%.
Okay.
So, yeah.
Awesome. I didn't know what mezzanine was. Now I do. Thank you so much.
Yeah, come on to us if you need help with it. So
Definitely will. Thank you, sir.
what's up, Edward? You're muted.
That was my fault.
No.
Can you hear us? I'm not hearing you.
Yeah, we can't hear you, Edward.
Is you on mute?
You should be good
No.
now. No?
Still can't. I don't know why it's doing that.
Night, Dr. Charles. Good to see you on here.
No, still can't.
All right.
Mess with it a little bit and then we'll come back to you. Keep your
Yeah, we'll
hand.
come back to you.
Yeah.
All right, Matt.
Hey, so mezzanine debt, is that just the debt, like the portion between the assumable and like the total purchase price? It's just
Yeah.
making up the gap?
Yep.
So what's a typical structure of that? And would we be, obviously it's gonna depend on the terms of the assumable loan, but what's like repayment look like?
You're usually a couple points higher in interest rate. There's some that come like an equity partner, where they just take a percentage of whatever the profit is on the deal. There's some, they'll act just like an equity partner or an LP. But then, the most common that I see is just, you might be in 8.5% right now in some of that debt. So.
Would they take second on?
They would take second, and actually a lot of the mezzanine or equity debt, just kind of an FYI to everybody. The way I understand it and how they protect themselves on this type of debt is they have clauses in their loan where if you mess up on the property or the property's not making money or you're not able to pay your obligations, that kind of thing, they'll take the property over. And they'll just take over the management of the property. Instead of, going through a foreclosure process like the first lien holder would. They will actually take over management and kind of kick you out of the deal. So, and that's how they protect themselves a lot of the time on these deals like that. So,
Would you be double paying? Would you be paying first and second debt, or just the first until that's off and then you'd start the second?
Oh, as far as you would have to pay both, you'd have a monthly payment on each.
Okay.
So, and when you're getting your secondary loan, you're going to still be between the two loans. You'll need to be like a 1.2 DSCR still. So.
So that's pretty tough.
Yeah. It's got to be bigger deals. I mean, and it's assumable at 50% or whatever. And then, it works on the bigger deals a lot of the time where you've got to raise, 40 million, you might get 10 million that you can borrow as a secondary or mezzanine debt or whatever. So.
Cool. Thank you.
Yeah. Jaden.
Howdy.
Hey, how you doing?
Good. Hey, got a question. So on my napkin underwriting, what should we be using as a figure for our interest rates right now on agency debt?
On agency debt, I mean, what we've been quoting here this week, we actually today we quoted about $75 million in debt today on 6 different deals. So yeah, we've been doing a whole bunch of underwriting today.
Nice.
But what we've seen today, 5.8 to 6.2 is what we've been doing today on just about everything. Has been anywhere from 5 on agency debt, anywhere from 5.8 to if you write at 6.35 to 6.45, you'll be more than safe
Okay.
right now. Now, keep an eye on your 10-year treasury, because if you go under contract on one and the 10-year treasury has jumped up some, the rates are going to jump up as well. So I was listening to I don't know if anybody else here listens to Bigger Pockets, but I was listening to a Bigger Pockets podcast last night, and they were talking about the interest rates with the debt market and with just the real estate market in general. And they were saying the interest rates right now are kind of like the Kardashians of the real estate market, that, everybody's paying attention to them, but they don't really matter, when it comes to the long term,
Right.
So
Well, I heard they said Jerome Powell made a comment that they underestimated how much they're going to need to raise interest rates.
Yeah. So I think we might be seeing rates for the rest of the the rest of the year, maybe. I don't know. Who knows?
Yeah.
Most
and then what kind of a bill do I need to get in order to get agency debt versus, I understand probably I need above, say, 92 or 95% occupancy.
over 90% occupancy.
Okay.
And like we talked about, was you here earlier? I didn't mention the occupancy, but yeah, over 90% occupancy. That's the number one thing. And the loan amount's going to need to be over $1 million to qualify for agency debt.
Okay.
Yeah, there's a lot of aspects to it.
Well, I know there was one I'd reached out to you earlier in the year that we were underwriting in Tulsa. And we're going to try to reach back out to that seller again.
Okay.
I think Jason Kurt was the one you ended up probably visiting with about it, but
Okay.
I think she was at like 87% occupancy when we first started. She was right at the borderline of 90% when we last spoke with her, and she was trying to get it over 90,
Okay.
up 92, 94%.
Yep.
Because I think before we couldn't get agency debt on it when we last spoke with you about it.
So if we get to the 90% and you have a 3-month average of 90% or better of the trailing three, if you get 90% or better over the last 3 months average, then you'd be good.
Okay.
And generally,
right,
when we're underwriting for the agency debt as well, they're going to look at the last 12 and they're going to want to know about it. But if it's a property that's up and coming, like it's a new lease out or they did rehab and are now leasing for that, they're going to give you the last 3 months. The T3 is what they'll underwrite your NOI and things at. And they'll just kind of average what it'll be the next 9 months based on the T3. So.
Okay. And what's the best size limit? I mean, like right now, that one was being sold as a 96 unit portfolio, but it was actually 2 separate units that were 48 units each.
Yeah. I mean, you might be safe and you're better off. And I'd have to talk to some of our underwriters there with that, but we might be better off doing them in 2 separate deals, 48 and 48, just because of, Freddie Mac, their small balance program, they're looking to lend, 5 to 50 units. They've come out this year saying, we want to lend on 5 to 50 unit properties. And we're going to lend on these properties. We're going to lend on, $2.5 billion each, 18,000 units each, Freddie and Fannie both. They want to lend on that size of properties. So might be a good opportunity to do those separately and have them done that way.
And then what do you know about apartments that have been previously, they were like a hotel, kind of like a top and bottom? Do you see that as being something that the value add is really there for, when you got to have a set of stairs and a long runway to get to half of these apartments?
Yeah, I mean, it depends on the area. Yeah, I mean, there's a lot of areas where, I mean, people are renting anything that they can rent. If you're in a good market where people want to be, I mean, you can rent anything out and make money at it.
Okay.
I mean,
this one's in Stillwater. Oklahoma. It's a college town, so there's
Yeah.
the potential of making it like student housing perhaps, because they're all 2-bedroom units.
Yeah.
Um,
And what is it? University of Oklahoma or Oklahoma State that's in Stillwater?
Yeah, Oklahoma State.
Okay. Yeah, I mean, that's a big main college, so student housing, Fannie Mae will lend on student housing if it's a top market college, so.
Yeah, it's kind of like an extension of the college. It's not the home base location, but it's still a good spot for a lot of students. So,
Okay, cool.
all right. Well, thanks. Appreciate it.
Yeah, no problem. You want to try it again, Edward? Still can't hear you.
You want to try it? We'll try it. We'll come back to you again.
Yeah, we'll come back to you again in a little while. All right.
Ayana.
Ayana.
Oops. Hi, good night. How are you?
Hey, good. Good. How are you?
Doing well. I just had a question on the SB program you mentioned.
On
Do the
SBA?
qualifications change? SBA.
Yeah.
Do the qualifications change from what you shared earlier for agency debt?
Yeah,
far as-
SBA. Actually, 2 calls from now, I guess it'll be the first week of April, we're going to do our call. Our call will be all about buying commercial real estate with SBA loans. And we'll be talking all about SBA loans on that call. But SBA loans, need a business attached to it. So if it's a smaller hotel, a storage facility, or there's people even buying businesses that have the real estate attached, whether it might be a big flooring company that has a showroom in a storefront or whatever, and they buy the flooring company along with the real estate. They don't want the flooring company, they want the real estate, and then they'll turn around and sell the flooring company separate from the real estate and keep the real estate. And they'll do that through an SBA loan sometimes. There's just a lot of ways to work SBA loans, and each SBA lender has kind of their own requirements. So we'll be talking more about that. That's as far as lenders go. We have a lot of different lenders, but when it comes to SBA, I think we have more SBA lenders than we have anything else as far as options. And each one has their own things that they like to lend on, their own types of businesses, their own amounts. But SBAs are cool. We even have one SBA lender. If it's a deal they like and a business they like, they'll lend on it with zero money down. So you can actually buy a business with this one SBA lender we have with zero money. So, there's a lot of options out there. So, I hope that helps a little bit. But yeah, it's the SBA program, Small Business Administration, and we'll be going into that next. Our next Zoom will be on bridge loans, and the one after that will be SBA financing. So,
Okay, look forward to that one.
yeah, cool. Yeah.
Hi, follow up on that one. Is the SBA lending, does it cover franchises?
Yeah.
Okay.
Yep.
That's all I'll ask on that, since you'll go in it more in depth, but.
Yep. And just like I said before, there's SBA's lenders and there's certain institutions, banking institutions, and there's even some SBA lenders out there that are not affiliated with banks, that are just SBA lenders. That's all they do.
Right.
And some of them will lend on franchises, some of them won't. So it's a matter of getting to the right one with the right product. So
Awesome.
So Edward, did you want to try one more time? I see Daniel says, I need a franchise lender. You should give us a call tomorrow, Daniel.
Okay, I'm just logging on. I don't have any of your information, and I'm on my phone. Is it in the chat?
Okay.
What's
that?
that?
Go back to the page there, babe, with the with our contact info, and you can take a screenshot of it if that helps.
Yeah, sure thing. That'd be great. Yeah, because we had a few investors interested. One of them just fell out yesterday. She changed her mind. So
Okay. Gotcha.
yeah, no, we have a tremendous opportunity here in the Valley in California.
Okay.
We're taking over the franchise for the GJ Gardner Homes builder.
Okay.
The old owner passed away about a year ago, and you know, this is a great area. They do a lot of volume for new home construction. So, you know, we're gonna open a design center up and take over this area.
Awesome.
Great opportunity.
Awesome. Yeah, if you see our contact info on there, that's mine and Shelly's emails, and then that's my cell phone number.
Okay, awesome. So what do you guys look for when you're doing lending, you know, on that type of product?
On SBA?
Either one. It's for a franchise. I'm not sure what SBA covers. Or
Yeah, SBA is the best. I mean, if it's under $10 million and it's a franchise, SBA is probably going to be your best bet.
Yeah. Okay. Yeah, we only need like $200,000, honestly.
Okay.
One or two investors would be great, but I mean, if we had to go SBA or whatever lending institution wanted to get behind it, we're totally open to that.
Okay, gotcha. Yeah, when it and I didn't say this before, but when it gets under the 350,000 mark, it gets a little tighter or harder to find an I have probably 12 or 13 different SBA lenders that we have in our pocket here that we can use, and probably just one or two of them that will lend under 350,000.
Okay,
so that cuts us down when you're looking at lower amounts. You know, so if you have like real estate, like you're talking about building a you know, a design center and things like that, you know, if you have something like that that can add to the loan amount, that might actually help you to get financing. You know, you could buy some real estate with it, you know, do your design center up nice. And that actually that will help. You know, you get funding when you're looking for more money. So
sure. I mean, we could get more if we needed to.
Yeah.
Or apply for more. You know, we're just that's the requirement though. At least we need to have at least $200,000.
Okay.
So
cool. Sounds good, Daniel.
Okay.
Yeah. Give me a call tomorrow.
Absolutely. Thank you. Appreciate that.
All right, so let's go ahead and see if we can get Edward to talk. And after Edward, I have somebody with some information that may help you guys. So I want to bring her up as well.
Okay, can you guys hear me now?
Yes, we can.
Yeah.
Awesome.
No, I had to go back to my Mac because I just bought a new computer for my business. So it seems like Zoom is still giving me issues.
Gotcha.
Yeah, well, so I want to be a little bit educated on this. So this is on qualification, I believe. And then Jerry says the net worth requirement need to be equal or greater than the loan amount. So can you please a little bit go back on that? And then the second question that I have, does the source of income for the tenant matters? When you want to get as far as like the occupancy, sorry. So as far as the occupancy on the property.
As far as the net worth, so you take all of your assets and subtract any debts from them assets, and that'll get your net worth. So, you know, you look at, you know, any real estate that you own, take off the amount of money that you owe on the property. That's how much that property is giving you a net worth. You have your contracting business, whatever you can value your contracting business at, that would be part of your net worth. You know, I mean, we have some real estate that is part of our net worth, but you know, we have a 20-year-old roofing company that does a whole bunch of volume that counts to a bunch of our net worth. And then we have our mortgage business here that counts towards our net worth. So, you know, that's what you look at. So generally when you're looking at business, you know, you can count some of your the things that you own through the business, you know, equipment, you know, things like that. Then they'll actually take, depending on the business, kind of a general rule of thumb, whatever your profit is per year, multiply it by 3, And that's kind of how you would value your business when you're looking at your net worth. So
Well, thank you so much. That's great.
yeah, no problem.
Great.
Awesome. I want to bring up a lady that's been a part of our lives for a while and a great friend. And she's got a marketing idea that I think can benefit you guys. And I want to grab her here. Kat, are you able to unmute?
I think I did. Can you hear me?
Yes, I can hear you perfectly. Awesome. Go
Oh,
ahead.
terrific. Well, thank you so much. And I'll share my information in the chat in just a minute. My
Mhm.
name's Kat McEntee, and I'm a publisher for Best Version Media. And Best Version Media publishes over 1,200 magazines across North America. And these magazines are neighborhood magazines. We target the higher, more affluent communities that really targets that ideal customer for a business. People that have high home value, people that if you have a window or glass company and Johnny hits the baseball through the window, mom's going to have to call somebody to get that fixed. And these magazines are directly delivered to the homes every month. And we have a product. We look for experts in categories. So an expert roofer or an expert general contractor, a person that's an expert cleaner. And you get to submit articles about your business and educate the community about you to build that relationship in those communities. We really micro target, and we combine the magazine also with a social media package. So you really get that 1-2 punch. And we go everywhere from small towns in Kentucky all the way to Beverly Hills. I've even put folks in our Beverly Hills magazine. So I'm based in the Northern Kentucky area, and we've got close to 20 magazines in the Kentucky, Cincinnati, Indiana area. But I can put folks in any magazine across the US and Canada. So if you're interested in hearing more, I'd love to talk to you, find out what magazines we might have in neighborhoods that you're interested in, and see if it's not a good fit for you. I've known the Miles family for a very long time, since their kids were very little. And they're such great people. I always enjoy any time I get to spend with them. Thanks for letting me share.
Yeah, thanks, Kat.
Awesome. Thanks, you guys. Take a look at this. I know some of you have businesses in here, and I think you guys can really benefit from this magazine. And Kat is a great person to work with. And she's going to drop her information in the chat, and just reach out to her and she'll give you a little demo on what it is and on what's going on with that stuff and how she can make it work for you and target your clients.
And also a side
Absolutely.
note with Kat, she is also a talent agent and sends a lot of kids to Hollywood. So JJ
Yes.
has been an actor since he was a small child. And she's put him in quite a few commercials and actually helped him get signed on with a Hollywood agent back a few years ago. So, and helped him a lot with his acting career. So,
Yeah, absolutely.
You've got very talented kids in your family.
JJ is a rock star.
I know. I can't believe he's going to be 17.
I know. Kat, he's been with you since he was 10 months old. And now
I
he's
know. I know. I don't know how this happened.
I'm not sure either.
all right. Well, do you want to show them the last thing that you said you was
Yeah,
going to show here?
so I had a gift for you guys, and I'm going to show you that gift right now. And Jerry, if you want to go ahead and
Yeah. I don't know. A lot of you guys have probably heard of the Spartan Death Race. Anybody that was at GrowthCon knows about this already. But the guy that started the Spartan Death Race, the TV show and things, actually spoke at the GrowthCon. And with this with this code here, you guys can do any of the Spartan races. They take place all across the country, all through the spring, summer, and fall. Even in the winter, I think they do some. But they do 5K, 10K, 20K. But they have obstacle courses and all that in them. And me and Shelly have committed to doing the one in Asheville in August of 2023. And anybody that wants to come and hang out with us for a day,
Oops.
we will be there. And we're going to try to get in better shape so we can run the race. So that would be a lot of fun to have some of you guys come and join us.
Yeah.
And do some monkey bars and rope climbs and some running and stuff with you. It should be fun. So anybody that wants to join us there, let us know and we'll put you on the list. We'll probably be taking our camper down and camping for a few days, and we can reserve a whole bunch of camping spots all in the same place and all hang out for a few days. So anybody that wants to come, let us know.
Yeah, go ahead and take a screenshot of this. You can use the code 10x growth comp to get it's going to be free. Actually, it's like $80 to $100 per person.
Race, yeah.
So
To join a
the
race,
race
it's
it might be
expensive.
more now. Last time I looked, it was $80 to $100. I don't know what it is now, but that doesn't include insurance and fees. I'm not sure what those are, but I mean, this is a great opportunity for us to all get in shape and do something together.
Me and JJ are already in shape, so
Yeah. These boys got muscles.
Yes,
Anyways, that's it. Here is our next topic for 2 weeks from now. We're going to talk about all about bridge lending, March 22nd. And then our topic after that will be how to buy commercial real estate with an SBA loan. So if you guys want to join us with that, and those are the dates for that, March 22nd, and then the next one will be April 5th, as we do this every other Wednesday. We're not on here every Wednesday, but we are in here every other Wednesday. So I would love for you guys to keep that in mind, because we don't see you guys every week.
Yep.
So, and what's next? Again,
all right.
JJ,
Join the
go ahead and
community.
throw the Freedom Chasers link in the chat, and you guys can join these people. Very educational, great stuff. I've been on every one of these calls. Good stuff. The broker talk is awesome because they call live brokers. They call brokers live, sorry. And it's at 2 p.m. so they can get a hold of these brokers. Obviously, the activation Zoom is great and a good way to start your week. And then Tuesday at 8 p.m. you have the napkin underwriting, which is awesome. And then us every other Wednesday. And then Victor is doing the alternate Wednesday from us. We're doing a Wednesday, and then next week it'll be Victor with his advanced underwriting. That's it. Here's our picture. Here's a contact information again. If you guys didn't get it, go ahead and grab that. And that's it. Thank you guys for joining. I appreciate everybody. You guys are always active in the Zoom. Just let us know how we did and if there's anything else you guys want to hear about, and have a great night.